Hello and welcome to NETV Profit. So we're here at State Bank of India after the bank has announced its Q1 results. And I have the pleasure of talking to Mr. C.S. Setty, the chairman of the bank. Mr. Setty, welcome to this conversation. I'll start this with the first question on profitability. You've reported a 13% increase, year-on-year increase on the net profit side, while the NII remains flat-ish. You've seen that growth come in because of the non-interest income. Can you tell us a little bit more about how this profitability is coming through for SBI?
The growth obviously, supported by the treasury gains, and we, as you know, we have the largest securities book, right? So we have used our treasury operations both by way of churning the portfolio, that is what we call trading gains, and also a bit of aid on the MTM gains. But broadly, what we have realized that, what is the earlier duration what we have obtained on the securities book, we took the opportunities of gaining on the trade front. So that is one of the reasons why it has contributed. But you also have to look at NII from a different perspective. The net interest income will be always under pressure because of the rapid repricing of the loans.
Right.
30% of our book, when compared to others, of course, is a smaller size repo-linked book, but still gets priced very fast and almost immediately. But deposit will take some time. This lag also is something what we have pressure on the NII. But I believe that we were able to maintain the rate NII at a reasonable level than what people have expected. The third point what we have done is that we have contained our operating costs. If you see from year on year, the operating expenses have remained at the same level. So these are some of the points which have helped us to maintain the growth rate what you have seen in the profit.
All right. So on that note, I want to ask the second question, which is that the current global scenario is looking a little bit, off, right? If you were to look at the geopolitical tensions, that is receding a little bit. However, when you're talking about the global market scenario there, because of the trade tensions, the pressure is still on. So I just want to understand from you, as a lender to a large number of SMEs as well as exporters, how exactly are you seeing the tariff tension play out in the world?
So I would like to answer this question in two parts. One is the direct impact of the tariffs. From that angle, the asset quality or issues on the corporate or MSME side is limited. Because most of our exporters are broad-based, both in terms of geographical spread as well as the nature of exports, what happened from India. But having said that, the US is still a significant trade partner for us. And the tariffs issue is not localized to India. The tariffs is impacting several other countries, which means that, as you mentioned, the trade tensions are there across the globe, which will have definitely an impact on our exporters also. Even if they are not directly exporting to the US, are not directly involved in the sectors which are impacted. But general sentiment is something what probably is a larger worry than actually direct impact. So the uncertainty surrounding this tariff is something what needs to be resolved or addressed. I'm sure a lot of effort is going on the Government of India part to sort it out. And the Government of India obviously has to take care of the interests of the nation and the interests of the various stakeholders and negotiate on the trade front to arrive at a very win-win situation for everyone.
Okay. I want to ask you two more questions. The first one on the credit growth side of the story. So you've shown 11.5% credit growth, which is looking quite strong. However, if you were to look at the corporate book, there the growth has actually been flattish. I just want to understand, what the outlook looks like for the rest of the financial year.
First of all, let me explain why it looks muted. I think in any declining interest rate scenario, most of the well-rated corporates look for repricing. The refinancing opportunities where the pricing can be readjusted, particularly those high high-priced loans and all.
Sure.
They have various options. Either you negotiate with the existing lender or go to another lender who is able to give a better price or access the market. And all of them are happening now. So which means that wherever we feel comfortable, the risk is priced properly, we are able to reduce the price and give to them. And in many cases, if we are not very convinced that the price is properly taking care of the risk, we are letting that go. So there have been significant prepayments in the Q1 because of the price adjustment. Number two, the working capital utilization by the large corporates has come down because they were able to access the CP market. So both in terms of access to the CP market as well as repricing which is happening in the market, which is led to this. But our guidance is that overall credit growth, we are still sticking to 12% credit growth, out of which corporate will come back to double digit in our estimate. Around 10% is something what we are looking at.
All right, the final question is around the asset quality front. Of course, if you were to look at the Q1 slippages, that's a little elevated. Of course, a lot of it is seasonal. But are you seeing any elevated stress, any enhanced stress anywhere in your portfolio right now?
We are not seeing any enhanced. And I also mentioned that, you need to look at the Q1 of the last year. And very marginal, 300 or 400 crores on a book of 42 lakh crores is not really material to us. And even from these slippages, we pulled back almost 1,600 crores worth of slippages, which means that there's no concern on the asset quality at all.
All right. Thank you so much for joining us in this conversation, Mr. Sethi. Pleasure talking to you as always.